and then they have started getting listed. The first REIT got listed in 2019, and I think so far there are 6 REITs which have been listed in the market. And out of the 6 REITs today, 5 of them are grade A offices, commercial properties, and one of them is a retail REIT, which is basically the malls, which is what is inside the pool of that REIT. So we'll discuss what is exactly how it is constructed. So here is the REIT structure. So like I explained that what is a REIT? It's nothing but a pool of money where our investment gets channelized into set of assets which are income generating. So they throw up the rental income and they comes to us. I'll just explain one by one the flow. The first is the REIT unit holders, which is investors. Let's say they buy 100 rupee worth of REIT that gets invested with help of trustee and investment committee into set of income generating properties, which can be office buildings, retail properties, warehouses, hotels, residential rental, anything of that. In turn, what gets back to us is rent or lease income, and it comes in a 3 format, so which I'll explain. So the way money gets invested is you invest 100 rupees. The investment committee may think that it can leverage this investment further up to 50%, let's say approximately, and they can invest 150 rupees on behalf of us. So instead of 100 rupees, they're taking another 49.50 rupees additional leverage, and they're investing 150 rupees into the set of assets. These assets in turn are generating rentals, and that rentals we are getting as a return in form of dividends, interest income, and debt amortization. And I'll explain in the further slide how this works. So these are the characteristics of REIT. So as per SEBI, what SEBI thought was it should have a proper structure wherein there has to be some guardrails how these assets have to be managed. So just like mutual fund also have a lot of regulations, this also has similar regulations. The first criteria which SEBI says is that 90% of the distributable cash flow has to be passed on as a distribution payout to the investors of a REIT. So what is distribution cash flow? Rental income plus services. So when you let out a property, what typically happens is आप उसमें rent लेते हो, आप उसमें कुछ service charges लेते हो. You give them common area, you give them pantry, you give them car parking or car pickup and drop service, something of that sort. So those are service fees. So you put together rental and service fees is what the REIT investors typically enjoy. But there are some operating expenses also to facilitate this giving out the property or servicing these clients. You subtract that, and then you also pay the tax on whatever rental income the properties have generated. And whatever is left, 90% of that is distributed amongst the shareholders or unit holders of the REIT. And that is what the criteria is, that as per SEBI, you have to distribute 90% of it. So these companies, these REITs typically cannot reinvest or reinvest for growth. If they are to pursue growth, they'll have to come back to the unit holders, tell them that we are raising money from you again, either in form of QIP or rights issue or something of that sort, and only then they can acquire more assets. But like to like, they will not acquire the assets by the existing profits of the annual profits. They have to distribute 90% of it. This doesn't happen in equity typically. In equity, what happens is out of the 100 rupee in profit a company earns, if they give out 20 rupee dividend, 80 rupees they reinvest and grow the business. Here the idea is that 90% is paid out. So this is one way to think that 90% of the rental income, whatever is generated, it will come back to you in form of distributable income.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.